When you're seeing the bond market still be so volatile, when we see a still incredibly inverted yield curve, when you just see still people not quite knowing whether they should be in big tech or not, where are you allocating in this moment?
Well, I certainly think the fixed income market, broadly speaking, is the most attractive it has been in arguably over a decade. It's one of the reasons why our long-term expected returns for equities and fixed income is increasing. I mean, the biggest silver lining, even if we fall into recession, the biggest silver lining clearly is higher real or inflation-adjusted interest rates. It was pulling down expected returns for all asset classes. That felt great in 2019, wasn't going to feel great in the future, but now we're starting to see that calculus shift. So fixed income, broadly speaking, high-quality munis and treasuries are actually starting to look very, very compelling here.
What does this change from what you heard on Wednesday about more about the destination versus the journey and staying longer at that higher destination that Jay Powell alluded to on Wednesday? How does that change also, though, the way you think about the equities?
Well, I think equities, again, they're approaching fair value if you look at the U.S. equity market overall, but they still, if we're right with a recession coming, you tend to drop below fair value because risk aversion spikes for a time. So I would like to think that we're close to the end of the market losses, but I think it'd be naive to think we're out of the woods. Nevertheless, if you have a long-term orientation, staying invested is certainly better than trying to time this market, because I think that as soon as the stock market gets some whiff of the Fed having plateaued in their Fed hike, and or we see a upturn in the economy, I think the market is upside for a time.